Sound is okay. This is Andrew, John. I will introduce myself. I normally don't do these webinars because, Mark is our media and marketing guy. So I just kind of stay in our chat room and teach classes and manage our risk and stuff like that. So, but you're gonna get me today. All right, so we're gonna talk about trading weekly options. This is, am I shy? Well, not really. I was a floor trader for 16 years. I don't know how shy that is. But I'll tell you a story at the end, and then maybe you'll see. Oh, thanks, John. So this is what we'll do. I want to try to cover the material. I want to do it in about an hour. I want you to ask questions. We'll also try to take questions at the end. So again, remember, this is a technique about trading weekly options, and this is, you could call this this is like a little precursor to our Saturday class on the 27th. Okay, so it's going to help you out a little bit. That Saturday class will go into more detail because we will go into more detail about volatility and positioning in the Saturday class, and a little more on hedging. There is a Saturday class that you can sign up for, but it costs money, John. It's on August 27th. But anybody that takes this class and they send me a note at andrew@optionpit.com, I'll give you another 25 bucks off. It is on weekly option spreading and trading. Basically, how to trade calendars and weeklies. Okay. We will get into a lot more volatility detail and edge detail, though. Alrighty? But this should give you an idea. Okay, now normally this is where we will do some diagonal trading. Will you give me more info on Saturday class and discount later? Sure. Okay, this is Mark, but he's not here. He likes this, putting this picture with him and Liz Clayman on. However, I'm Andrew. I don't look like Mark at all. I'm about 6 inches taller. Anyway, I was an option trader for 16 years, a floor member. I had my own firm. I retired in 2006. And I actually found Mark a few years after that. Afterward, I helped with a software startup, try to bring 3D data to financial markets, which is still around. But other than that, I'm still trading. I'm managing the risk for our fund. I do the trading, and I do a lot of the training day-to-day in Option Pit. Okay, question. Is it true that put calendars and put diagonals are preferred at current vol and market behavior? We will answer that question more completely, but I would say in general, yes. But there is some problems with some contango in the. You're not getting a lot for forward. You're not getting a lot for your forward sale right now. And that's what part of this will be. No, he doesn't look 60. He's only like 36 or something. He's young. I'm 50. I'm old. I started trading in 1991. Which seems like a long time ago. I know, I just turned 50. I'm waiting for my my card. Anyway, that is me. If you want more about you can go to my website. And like I said, I do a lot of teaching. I do a lot of the pro teaching, and a lot of the daily work at Option Pit. How is the Saturday? Okay, last question, then we're going to move on. How is the Saturday different from a few months ago? Will you discuss single calls and puts on Saturday? We're going to talk mostly weekly, Trevor? Are you talking about the Saturday class? The weekly Saturday class? It's always a little different. Mostly because there's just different stuff. We can tomorrow, thank you. All right. We'll answer everything at the end. All right, so this is what we're going to talk about today. Okay? Time spread, calendars are spin-off spreads. Are spin-off spreads. I do not know what that means. You stumped me, John. So let's talk about this first, and then let's see if this answers any of your questions. Okay? What we're going to try to do, the key part of today, by the way, is really understanding how decay works in options, how decay works in weeklies. Because ultimately what you want is accelerated decay. That's how you make money. So we'll talk about the advantages of weeklies, why you use them, when they're not a good thing to use, right? Strategic use of weekly options, and then we have a trade idea at the end, something you could actually go out and do or try to do. Also, everything we teach in these classes for Option Pit are all derivations of basically floor trader strategy. Okay, meaning you're a floor trader, you're on the floor, blah, 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 you're trading a bunch of contracts, and you have to take the other side of something you don't want. Right? So when you put those orders in and you curse the market makers and the liquidity providers, which are all just a bunch of computers now anyway, somebody there has to manage the other side of the position. So what we've done is we've tried to say, okay, well, if I have to take the other side of the position, I want to make sure I can charge something for it. So we're trying in this class and in the Saturday class, trying to help you find where there could be some edge in these positions. Okay, what makes a position worth doing? Okay, so what we do is take kind of market maker technique or vol trading technique, and we have morphed it slightly for the retail audience, because the big difference is retail audience can pick their entry point, right? And this is what we will go over today. So all the stuff you see here is what we teach in Option Pit Live, what we look at every day in our chat room, and the stuff we post for our strategy. Okay. All right, with that, okay, again, this beginning type of course. So if you're super advanced trader, you can close your eyes for the next 5 minutes or so. So mostly options are just another form of insurance. What that really means is, though, how long is the policy in effect for, right? So the reality is as time passes, you know, your insurance policy loses value just like options, okay? But the option is still in force on the last week, right? As long as that it's in force, even though you only have a couple days left, it still matters. So what we want to impress upon people with weeklies is that creates some vagaries in how they trade. Okay? Insurance policies like options decay with the passage of time. Even up to the last minute, out of the money options, at the money options will have a lot of insurance value. So the reality is you have to start thinking not all options are created equally as you move to expiration. How well does software like view? So what I would say is we're going to go over that a little, Andrew. What I would say is software only models things as good as the volatility assumptions you make. So we are not actually in this class today. It's more like the Saturday class, going to discuss like all kinds of changing vol assumptions. What we're kind of lay here is the groundwork. So all that modeling stuff you see, right, is only as good as your vol assumptions. So you actually have to learn how to trade the vol before you actually are going to have a good shot at trading time spreads. Okay? At the money options, out of the money options are all extrinsic value. That is correct. Right? It's just juice. So what the thing when Mark sets up this deck is you've got kind of the linear time decay, right, at the money. So you sell stuff at the money and it decays like what? Like paint drying. And as option traders, when you sell options, do you want to sell something that decays at the rate of paint drying? No. Exactly. Like you just, that is a position, but if you sell a 2-month out option expecting all that juice is just going to go away because it's going to decay, you're going to be waiting for a very long time. All right, which changes the type of position you put on. However, once you get into the what we'll call the juicier part of the decay cycle, they're going to decay a lot faster. Generally, between week 3 and week 2, you're going to get, that's where the model really starts to bend. All right? Meaning options start to decay a lot because all of a sudden we're just running out of time. Could you just maintain the volume as you speak? I will try, Jay. Normally I just change volume up and down to wake people up. But if there's any other sound problems, you guys let me know. All right, so what we say is at the money option premium decays exponentially. All right. That is one of the cooler features. So the real values of weekly options is you're just trading the exponential part of the curve. Oh, it's weird. I don't know why that is. Let me see. Is my headphone thing on right? Should be. So what we're trying to be able to do is, if you're going to trade weekly options, you want to sell the fast decaying part of the curve. What do you mean by the exponential part? Well, see this part here, John? Drip, 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 drip. Should I be able to see the questions from the others? Unfortunately not in a webinar like this, Tag. But I try to read them. So you see this exponent, this is kind of a flat line, right? And then all of a sudden the line does what? It goes off the cliff. This is when at the money options are decaying rapidly. They are not decaying rapidly here. Okay. So when we're looking at a weekly, we want to sell stuff. We'll put it this way. Anytime you sell an option, you want it to go to 0 right away, right? That's optimal. But the way options trade, they only go to 0 quickly for certain reasons and over certain terms, right? So looking at weeklies, you're really trying to sell the stuff that's going to decay the fastest, right? Normally what we say is like there's a pop in vol or there's a pop in the front month. We sell that. We buy something behind it to protect the position, to spend as little dollars as possible, right? But the reason why is because the nature of decaying options. Okay, so what we're showing you on that other chart is really just at the money options. Question is, so certain underlyings sell off faster with decay on the option premium? Yes, depending on what the volatility is and the timed expiration. Okay, so if you get further from the at the money, you have what we'll just say is linear time decay. He's saying that's where the vol comes in. That's correct. So if you're going to trade time spreads and you don't trade volatility, you're probably missing 70% of where the value of the spread comes from. Right? Depending on where you place it, the other 30 will be, the directional part of the underlying. Right? And those percentages can flip-flop. Okay, but certainly it's a huge part. So what we're saying is, okay, you have your at-the-money stuff is kind of linear until the end, right? And then your out-of-the-money options are going to continue that linear decay actually to the final. Okay, except we're going to give you a little twist to that. But if you want to sell options, I hope this presentation will be sent to the attendees. Yes. So do you have a minimum IV to trade weekly spreads? Mini Mike will talk about that. Because what we'll do is we'll set up a price at the end, a trade that we have on in our strategy letter that I think is still executable. And we'll price those. Right? Because what you're looking at is minimum IV just means what's a risk he's asking, do I have a minimum IV? And really what you'll see what creates the edge for you in a particular trade. So what you're looking for really is there a spread that makes sense? What's a minimum dollars for a spread? So what you notice here, though, is the nature of decay. You have an out-of-the-money option, and then the at-the-money starts to go away real fast. So depending on the type of stock you're interested in or the pricing, right, you will get something that's a little more accelerated. Obviously, if you have an out-of-the-money that's not moving and an at-the-money that is moving, you're going to pick up more decay for that position. Okay. I got to turn off some of my IMs. So all we're saying here, remember, an out-of-the-money option is just an in-the-money option because that extrinsic value is the same. Okay. So in this case, all we're saying is, all right, if you're going to trade these, what is the decay profile of the product that you're trading? Right? You need to know that ahead of time. All that stuff is known ahead of time. Right? So the next part we'll talk about is just on risk control for the position. Okay, so John, he's saying there's not extrinsic value in the money. Why is it being compared with that of money? There is always, almost always, some sort of extrinsic value to an in-the-money option. Right? If there's value in the put on the other side, we'll do it at the end. There is value there. Trust me on that. It's okay. I'm here to remind you. So if you have this, right, where you're given a chance to flip a coin and it lands on heads, you get $1 million. But if it lands on tails, you owe 700,000. We would think that's a little bit iffy of a bet, right? Because when you're looking at trading options, you are, again, most of this is just odds. What are the odds? How do I put the odds in my favor for a trade setup, right? And there's all kinds of ways to think about that. Mostly we just look at volatility edge at option pit first. So even though there's a positive expected value for this trade, you like, okay, so I lose everything on a flip of a coin. I'm not into that. Okay. That is correct, Mark. He's saying variance. Variance and then standard deviation. So, but if you get to play the game 50 times before it paid out, would you play? Yeah, because the expected value on 50 times should be pretty good. You'd give that a shot. Well, maybe. Okay. So it is a big positive expected value, but you just have to come with a 700 just in case you lose. Okay, so so the webinar will be provided with links to everybody that signed up. Okay. So the next part of this whole thing is applying to teeny option trades, meaning how do you trade a weekly position and talking about closing a position. One of my favorite things to do trading options is to close a winning position, right? It's hard to beat that. Okay, but you still have to close it. There's something though where you look at some options and you think, well, they're out, they're worthless. or they have no chance to go in the money. So I'm not going to close them because I don't want to pay the liquidity providers a nickel to close them. Okay, now you'd think, okay, Andrew, you're an ex-liquidity provider. You want to make all your old guys a bunch of money by making you pay nickels for short options. Okay, but for anybody that has seen a short option that was priced at a nickel go to $6, you know what I'm talking about. And of course, as an ex-liquidity provider, I can never always cover short options. Sometimes you could, sometimes you couldn't. Okay, so here, when we're talking about cheap options and weeklies, this is where we want you to be careful. Right? This is the be careful part of the webinar. Right? Your at the money options and your out of the money options can decay to a point where they start to act like a coin flip, like our coin flip game. Right? You think you could sell an option for a nickel in a spread, think you're going to get that nickel if you hold it to expiration. But the problem is the risk associated with selling options or being short options for a nickel. Okay? And one of the reasons is market makers don't like selling them because the margin cost for them is expensive. For the dollars they get, they really don't like having a lot of short nickels on their sheets. So they tend to stay at those prices. Okay, what does that mean for you? It means if you sell something for a nickel, it's going to take a while to get it back. Right, so you've got your real option decay, then you have exponential decay, and then you see this kink in the line here. It's trying to squeeze the last pennies out of a trade. When are you going to get that money? That's right. Teenies used to be called 1/16th, right? So that's a 16th, so we used to call them teenies when they were fractions. Right? Way back, in the last millennium, I guess, before they wrecked the options market with decimals. So knowing that, now here's another thing. So some of the things we're learning about selling options are if you sell at the money options, they're not really going to decay very fast until you're closer to expiration. If you sell out of the money options or options close to expiration for nickel thinking they're worthless, they're not going to go to zero until when? Right? Till the very last minute. So remember, anytime you sell something, you need to be compensated for the risk you take selling it. So if you're selling stuff for a nickel or 7 cents or 8 cents or 9 cents or something like that, you're going to wait a long time to get that money. Okay? And a long time meaning to expiration for the risk you have to incur to hold it. Right? And that is, again, if anybody that's been in our chat room knows, that is not my favorite thing. When you say teeny, are you talking about out of the money options? I'm talking about options that are a nickel. They used to be a 16th, 0.0625. Now they're a nickel. These are the new teenies. Okay, options for a nickel, small dollars. Okay, so if we are thinking about where the edge in the weekly options are, okay, the last week of an options life has a huge amount of decay when it's at the money, meaning things near the money are going to decay very fast. Okay, that's what the model tells us. Out of the money options, okay, are going to decay in what we say is like a linear fashion. So you're going to, that last nickel for the option, selling out of the money options, is going to take a very long time to decay. So what we're telling you is if you sell out of the money options, the decay is actually going to be more like pennies per day. It's just not that fast. So Trevor is saying, so you are selling an option for a nickel. Is that right? Yes. What we're telling you is we don't want you to sell an option for a nickel. And the reason is why. Because you have to wait a very long time to collect your what? To collect your nickel. Yes. So for weekly premium collections, the short at the money and long the just out of the money for protection. Mike, you almost are writing my webinar for me. He's saying for weekly premium collection, you short the at the money stuff and you're looking for stuff just out of the money. That's basically what our guys in our pro group that sell premium do all the time. They're looking just for those types of trades. When I can get that super accelerated decay, I'm going to buy some out of the money junk for protection. I'll sell the junk in the middle and be happy. Get some compression, done. But that is the playbook for if you want to be what I'll just say is an aggressive premium seller. It's not that it's bad. It's just that, okay, I'm selling premium for a week, so you have to be risk controlled about it. Some will talk a little bit more in our Saturday class for weeklies. Can't get it all into the freebie webinar today. So Sue's asking, is that like a butterfly trade? It is. Yep, butterfly trade on different kind of ratios. Right, because you've all heard of pin plays and things like that. There are times when those are very advantageous. Right, almost all set up by what the volatility is trading for. So here, your just immediate takeaway is you just look at the pricing where your 36 is your at the money strike. Okay, you've got 31 cents of juice that's decaying. The value of the spread here, if you look at the May 36, okay, April 36, the value of the spread is 30 from 95 is 65, 66 cents for the spread. Right? Everybody see basically what the cost of your near the money call spread is? It's about 65 cents. Okay, and you're looking for a bigger chunk of decay here, right? Because you're selling an option for 30 cents or give her about 30 cents, 29 cents. Okay, if you look at the 37 spread here, you've got a price now. You're paying 37 cents for this particular spread, but if you sell the out of the money stuff, you're getting less options. Okay, the price reference, I'm just telling you 36 is at the money, John. If I say 36 is at the money, that's where the stock's trading. Okay, so this is a May 1 37 call. You're paying 51 cents for this. The May 1 36 call, you're paying 95 cents, but net on the spread, it's costing you 66 cents. Okay, here the spread is it's costing you 37 cents, but you're only picking up 14 cents on the calls you sell forward, knowing that it's going to take a while for that nickel to come in. So again, you're looking for where am I going to do best and where am I going to collect the most decay for the option that I'm trading. Okay, it's going to be somewhere near the money. Okay, then as you go out, the next part is you fast forward a day. Here's your April 10 series again. Your 37s are down to these little tiny options again where these prices are small. They don't go anywhere. How do you deal with gamma risk at the money? Well, that's what we'll do when we set this up, Patricia. Okay. It doesn't necessarily have to be at the money. It has to be what? Near the money. Right? It's the options around the money that decay faster in the weeklies. Okay? Okay, so when the lesson basically is Weekly trading is for near the money options, or as near as you can get, right? And create, she was just asking about gamma, meaning if the underlying moves a lot, what's going to happen to the position, right? But there's also information when you look at a particular trade telling you how much the market's expecting the position to move as well, right? So in 2 more slides, we'll get to that, okay? So if you're selling out of the money options, you're giving away money that should be in the back months. Basically meaning you have to hold a position for decay that you're not really going to get until the very end. And you actually have to hold the out of the money option relative to that. So unless you have a hugely strong opinion about the direction, those out of the money trades are going to be difficult to do. They're going to be difficult to make money on because essentially you move out from a spread into almost an entirely delta trade. Meaning it's almost all directional and you're really not taking advantage of the fact that you're going to have that accelerated decay profile by selling the near the money option. So try shining shoes for a living. Oh, wow. Oh, he was serious. He said, try shining shoes for a living. You cannot teach. Well, that was the first time I heard that one, but that's okay. So when you're looking at this, right, should one always sell weekly options when one is trading near the money? Okay. The next thing is, what about if you just sell covered calls or cash secured puts? Okay. So the idea is, instead of using time spreads, what's an alternative to using time spread, meaning I'm just going to sell some calls over stock, or I'm just going to sell cash secured puts. Okay. The trade-off being this, right? In return for whatever the extra premium is, you're taking on more price movement. So if you buy a back month option and you sell a forward option, you have a lot less dollar risk than if you start selling cash secured puts short term, or if you write calls against stock short term. So again, remember the whole idea is, if you want to sell near term options, you want to sell options that are going to decay rapidly. So the idea here is, if a trader is going to make more money selling 4 at the money covered calls than 1 monthly, meaning you're looking for more premium short term if you do this. The problem is, if you sell really short term gamma intensive options against stock and it really starts to move, what you have is you're opening yourself up to a lot more exposure that you have less chances to get out of. Right? If you sell longer term premium, you essentially have more time. If you sell very short gamma intensive premium, you have less chance to get it back. So when Mark actually was writing up this slide, okay, you have a lot more work to do selling short-term options against stock. Okay, basically you are going to be very busy. And because you're very busy, the fact that you have short options that are getting close to going, or basically getting close to going worthless, you need to buy those things back. Okay? So when we look at spreads, our edge right? The edge in these things are selling just out of the money options in the weeklies and hedging with some kind of option that is going to be a little farther out in time out of the money. right? And again, Mark's saying here, because of the hyper decay of the near-term options and linear decay of out-of-the-money options, you can make some money trading credit spreads or selling shorter-term options, right? And when he says some options should have some teeth but not be hyper, meaning let's say if IBM, looking at this as an example, he's putting, you're buying the 165 calls, right? You're collecting 56 cents to sell the 62.65 call spread, let's say, expiring what was last week. Okay. The SEP call spread, you have to wait another 3 weeks and you're collecting $1. So the idea of selling spreads like this, by at least buying the out-of-the-money option like we just said earlier, it's helping reduce the risk substantially of the option that you're trying to sell for, near the money anyway. So IV is so low right now, I'm not making much money on out-of-the-money credit spreads. That is right, Nita. It is very hard to sell them. So if you're not making much money on the spread, that means you're selling options for what? Right? The options you're actually selling, you're just not getting anything for. So what we would say is you don't want to do those trades. You really need to wait until something happens with the term structure, and we'll just give you an example on Alibaba, something that starts to waken up the term structure a little bit, where you actually can get decent premiums for what you're trying to sell. Does that make sense? Question. Suppose I have a butterfly with short out the money and spread the wings longs. Teenies might work too, but you might have to hold till expiration compared to a credit spread. So one rule about butterflies, Mike, is you don't want to sell, you don't want your protective wings to be options. What Mark said, you want something that has some teeth in it, meaning you want the option still has to perform a little bit. If you sell stuff too far out of the money, it's not going to work very well against the options that you're short. So you don't usually want to go more than one standard deviation away. So the alternative for weeklies, Nita, instead of doing credit spreads, is we start looking at time spread. And I have an example here at the end. Okay? Because vol gets so low, you could almost do double calendars. You just have to make sure there is enough for what you're selling. He's selling the 62.5 and he's buying the 65s in this example. And he's comparing the price. You're getting 50 more cents, but you have to hold a position for 3 more weeks. So Michael's asking, is there a vol target percentage to sell premium, i.e. 50%, or is the underlying dependent based on the stock history? When I'm looking at time spreads and credit spreads, or mostly what I should say is when I'm looking for, because I don't sell a lot of credit spreads unless they're put spreads, is I'm looking for at least 25 to 50% back on my spread. In my head to say, is that going, if everything goes perfectly, what can I make? Right? Rarely does everything go perfectly, but you need those kind of dollars to even be interested in the spread in the first place. So Mike's question is, you can still look for a butterfly, but what I'm saying is you can move the tails of the fly in closer to the money. Mike, he's saying, is the structure still a credit or a diagonal? But you just want to move the wings in a little closer. So what delta do I usually sell? It's going to be vol dependent, JP. We'll see it at the end. Again, it's hard to answer all these in a 1-hour webinar. Right, but it'll give you an idea. Theoretical value is the same as basically the midpoint at that volatility. Okay, so a theoretical value of 70 is based on the volatility of the strike they're giving you. Okay. So what you're trying to say is, or what we're looking at is where is the edge in our trade? Basically, is how we're going to place our position. How close to the money, and what can we think we can get out of it? Okay. But the one thing about weekly time spreads is you thinking of, don't forget as well, both sides of your time spread work. They work together, but they can also work independently. Meaning, if I sell the forward one, the forward option series is going to kind of have a life of its own, as well as the option series in the back. They're connected, but they could also have very different lives. So when I'm looking at this, so we have a trade on our strategy letter, okay, in Alibaba. So when you look at anything, look at the simple thing to do is just look at what the straddle is pricing, meaning the market is going to, so here for our example, the at the money straddle is pricing at, let's call it a little under $4. Okay, it's 378. So it's expecting a 4.5% move. So any trade you make, what's the expectation of the move already, right? It's already telling you you're expecting about a 4.5% move to the term. So as you set up spreads, right? As you set up time spread, you say the spread has to make money given the fact that I'm most likely going to move one standard deviation. So when you're setting up spreads, credit spreads, time spreads, any kind of weekly, look at what the weekly's pricing already. Okay, that's giving you a sense of what's possible. Okay, so if you're expecting almost no movement at all for your particular trade that you decide to put on, and right now they're pricing a move that's about 4.5%, going in the trade has almost no shot to work. Doesn't mean it can't, but the way the market's pricing, it's very difficult. Does that make sense? So what you want to do is take what the market is giving you for potential movement. Right? Because anytime you sell any option, you want it to move less than what the market's pricing. But it's giving you its best look right from the near the money straddle. Okay, you know what the market's expecting, Nina? She's asking, because that's where it's pricing the straddle. Right here, they're saying, okay, we're expecting a $3.78 move. So if your trade fails, if the underlying moves $1, right, you're setting yourself up at the beginning to lose. Okay, at the very least, you would have to have a very quick exit where you stop yourself out. And Trevor asked, what day do you suggest for setting these trades up? Again, it depends on, for me, it's a conditional thing. I don't do certain things on Mondays. For our fund, we actually sell certain options at certain times because of the decay profile. But normally what I like for trades that are expiring next week, I'm looking to sell near-term options right around like a Wednesday or a Thursday of the prior week, or even up to 2 weeks before. That to me is usually about the sweet spot on the decay profile for selling an option, right? About 2 weeks to expiration. Given that there's edge and it looks decent to do. But those are the things that are going to start to, right? Because if you don't get the movement in the underlying, that near-term option will start to fade very quickly. Okay. So what we have is, what are the things I do is just look at the vol and the term structure, right? Baba just had earnings and they crushed the IV, but the stock also ripped. So what we've had is we have implied volatility for the September term in the low 20s, which is about as low as volatility has been here. So I did not follow the 10 days to expiration. So you were selling an 8 days to expiration or 15-day option. So right now, if I sold the option today, Mike, I'd have 9 or 10 days to expiration till next Friday, right? For an option expiring next week. So you're looking for the 2 weeks prior to expiration are going to be your, basically we'll just call them your hot decay weeks. So you're selling basically, I would guess, 14 days to expiration if we're going by the calendar. That's about, I would say that's the long end, and you'd actually move that in even a little shorter. Does that make sense? You're not really selling something that has 3 weeks to expire, right? Because that first week, you're getting very, very, very little decay. So in the example here, what we set up is we're actually selling the August 26th, and we bought the September 23. Note, just on the simplest level, the volatility we're buying is 25, and the volatility we're selling is 25.77, right? You buy low, you sell high. So if my expectation is it's hard for the volatility to go below 25, where it is, they're paying me something now to buy this option and sell this one, because if you're selling higher vol, you're selling more decay. Okay? If I'm selling lower vol in the front month, I'm selling less decay. So what you want when you're looking at least from a simple weekly time spread is you want to make sure you have decay in your favor. You want the volatility in your favor. You want to sell slightly more expensive volatility than you are buying in the back month, with the expectation the back month vol does not go down a lot. After earnings, after a day or two, especially after earnings, are generally better times for these types of spreads, because there's still some latent volatility, especially if you just had a stock that just popped, right? So do you guys remember Apple, back in the old days when it would just explode, and all the buyers would come rushing in and they just pump all the near-term options up, okay? It was probably one of the greatest time spread trade stocks ever, because paper came in, they bought tons of near-term options, they didn't care about the back month options, and you could put time spreads on for very advantageous prices. You could buy the SEP9s. Okay, the thing with us buying the SEP23s, and we'll price it a little differently, is because we had a delta in mind as well. We're just looking for the stock to go to 100. Okay, but if I buy the SEP9s, what do I do to the trade? Automatically. Do I reduce the short gamma of the trade, or do I increase the short gamma of the trade? When I buy the SEP9s, I'm going to decrease the short gamma in the trade, but I'm also going to have less decay, right? Because the closer I move this September option to the one I'm selling, I'm reducing the risk overall of the trade, but I'm getting less decay, right? Because the SEP9 option is going to decay faster than the SEP23 option, right? So when you're setting these up, you actually go, okay, well, what's the decay by buying this one? What's the decay about buying this one? What's the decay about buying this one? And the cheaper you can get the back month option for what you can sell the forward option for, all of a sudden you start saying, wow, this time spread is not costing me a lot of money. Low cost time spreads generally produce pretty good amounts of positive theta going into the end of the cycle. Okay, so the idea we had was, BABA made a huge rally. We're looking for the stock to keep going up, but again, looking at the round number thing, stocks have a tendency to like those big round numbers, especially 100. So what we used was a weekly calendar in Alibaba. Basically, we were kind of bullish, but we like calendars because they produce positive decay, especially in a market that's not really going anywhere. It's going up, but you don't want to have negative decay. Right? So here is some of the things, kind of, let's say, a checklist. Right? I'm buying the year low volatility in Alibaba when I bought the SEP23 cycle. Okay? Doesn't mean it can't go lower, but you're already buying the year low vol. Okay? I was selling a near-term call that's just out of the money, meaning it's near the money. I'm looking at 2 weeks in for my short option decaying. And again, strategically buying a firm weekly, meaning I'm buying that IV30 low. I got a bit long delta. And the idea is I should end up with a cheap call when everything is said and done. So the actual trade was I'm spending 126. Okay, if you think about it, I'm spending 126 to buy the SEP23 August 26 time spread. Again, this is only $2 out of the money. Right? If, again, we get any kind of, it doesn't have to move up a bunch, it doesn't have to move down a bunch, but it's going to leave me with the SEP par call for only $1.26. And the way I look at trading these things, I know I can hedge that $1.26 somehow with a put or something like that. If I get, if the market starts to look a little iffy. But I look at these saying specifically, I'm getting good prices for the 54 for the August 26 pars, and I know it's going to decay rapidly because that's where I am in the decay cycle. Okay, so the trade looks like this. I'm short 41 gamma on a 10 lot. It's decaying at $45 per day. My risk from volatility is 65 vega, meaning every point the volatility goes down, it's going to cost me 65 bucks. If everything goes perfectly, I'm looking at about 45% on my money. Right, so that looks okay for a time spread. And the second reason being is I'm buying 10 calls or 10 call spreads, but my frontline delta is only 129. It's definitely long. There's no question about that. But if the stock is going up, won't the IV be going down? It could, but that's why we're already buying year lows, right? So if we look at it, if the stock goes up, my max profit, let's say, is 500 bucks. For me, if I lost that whole $500, that means the volatility has to go down 8 points, which would put it at about 18, which I don't think it's been that low. But you can quantify what your risk is to volatility just by using the Greeks. So you know going in what the risk of the position is. And that's part of trading weekly calendars. You want to know what the risk is. Right? So this is actually the trade in our strategy letter. I unwound some of this prior to the Fed. Exactly. Sui's asking if I want less directional risk, can I use another calendar using a put? You can. What I will do normally is I will buy a put as a fraction of the premium. You can buy puts or you can buy put spreads to dump the risk. Basically, when we put this trade on, I put it on for as little directional risk as I could and just let the underlying move either up or down. And it kept moving the way we thought it would move. But there are tricks that we use that we'll talk about on Saturday, but there's all kinds of stuff. You can ratio the spread. You could ratio your double calendar. You could buy 10 calendars. You could buy 10 back month options and sell 5 forward options. You can buy 1 calendar or 1 put against 5 calendars. Usually the ratio I like is about 5 to 1. Why use a calendar and not sell a put credit spread? The reason in this case is because I wanted the upside potential. If you sell a put credit spread, right? And another problem is try to sell a put credit spread. You didn't get any money for it. And you get 30 cents. Just the volatility wasn't high enough to sell a credit spread, but the term structure is better for the calendar. That's the idea. So this was in our strategy letter. We closed half of the position today, prior to the Fed, just for a risk control thing because we were really long. But what you can do is, and this was a good question, I just keep them because when we close the position tag, let's say we're up $400 on the 10 lot, right? They already marked the puts down to like 50, so we only have $1 of risk left in our puts. So I prefer to keep the puts so I can ride the calls longer. Does that make sense? I keep puts if I want to ride an upside longer. Because one of my rules when I buy premium is I don't want to wake up tomorrow and have my premium go to 0. So when I set up almost any type of trade, the only way I would control that is either one by owning puts or owning calls, depending on what kind of spread it is, right? Or having a hedge somewhere, like I'll buy a couple of SPY puts, again, depending on what the type of spread is. I don't want to hold overnight positions where if I'm wrong about direction, I just lose everything. Vol term structure, is that your question, A? The term structure makes the spread nice. Okay, so when we say calendar, we really mean diagonal since the strikes are different. Some calendars can be diagonals, not all of them. You can trade diagonals, but as soon as you trade a diagonal, you add more short gamma to the position. I normally like diagonals for put diagonals when I'm trying to kind of scoop a stock lower. I like put diagonals when I can get them for credits that are out of the money. So, got you. Okay, you wanted a cheap call, take advantage and move higher. How is that not directional? It's not necessarily directional because if I'm wrong on direction, the position still had a chance to break even. So when I try to set trades up like this, if we keep going up, I want to be right. But if we fell apart, what are the two things that are going to happen into this position? If BABA didn't move and just fell apart, started to go down, what's going to happen? Volatility is going to go up, and we're long Vega. Right? And our delta is going to flip to short relatively quickly. So when we had this priced out originally, we had a price, so if Alibaba was down $2, we would start getting short deltas. And it was actually very close to break even. So what I'm trying to do is I'm setting up a trade that has a directional piece, but I don't have a ton of directional risk. But if it does keep going up, we have a chance to have it be a home run. And that is risk-controlled trading. I think this is the straight calendar without a put. Right, so when I trade a straight calendar, if it gets to my basically somewhere around to a downside area, then I'll either add put spreads or I'll close the calendar because I just assume that I'm wrong. But normally I will not trade just a straight calendar without some sort of protective option. Now here's something else for you to think about. Protection for this particular position on a 10 lot, I bought 2 puts for 102. So the lower the implied volatility is, the lower your put protection is going to cost, right? Does that make sense? You can't make a trade like this when volatility is trading 50, because number one is this call spread is going to be astronomically priced, and these puts are going to be very expensive. It's not going to look good on your risk graph. When I say term structure, I mean IV term structure. That's correct, A. It's this here. Because remember, the higher this option price gets volatility-wise, the lower the gamma and the more rapidly decaying the position is. Okay, what criteria do you use to pick the 89 put? The criteria I use to pick the 89 put is I want to spend as little on protection as possible for my call spread. So basically, if I got a move down that's in 1 standard deviation, I want to protect that. Right? Because I'm making the assumption that just because I think the stock's going up doesn't mean it's going up. You know, when you have a trade that's expiring in 2 weeks, right? I mean, how long can you afford to be wrong? Sigma is just the average volatility for the term. So that's what this is right here. They're saying, okay, the average vol is 2577. The average vol for the SEPO2 is 2576. So it's just giving you a broad brushstroke on, okay, the vol's a little higher here, short term. Okay. So the idea of this class today, except for the guy who didn't like it that left all grumpy, is we're trying to set up one, you're trying to sell options that are going to decay, where they're going to decay, the idea of closing short contracts, okay? And when you price the trade, how much can I make? What's the risk? Is it going to cost me? What's my cost to hedge if I want to hedge? Right? So you're thinking of this stuff, okay, before you execute it. Right? This is kind of what we do in our chat room. We just put all these trades up and see what looks good. Because it's not enough to say I just think BABA's going up. That's fine. The put was outside 1 standard deviation, but it performed for 1 standard deviation. So if you have a position, I think it's here. Let's see if I have it. If I could spell. So here's the position. This is the delta now. I think when we put it on, it was trading 94 bucks, right? So what I say is, they're like, well, Andrew, that's not making, I'm losing money there, right? If we drop down to that level. The difference is there's no way the volatility is going to stay at 24. The volatility is going to be at 4 or 5 points, which actually means we pick up another 300 bucks, which means it's about breaking even down one standard deviation. And that's all I wanted it to do. I just don't want to have to walk in, the thing's trading 92 bucks and we're screwed. Right? Because the vol will jump, and then we either have a chance to just close the whole thing or sell out the puts, depending on how much it gets pumped up. So what you're trying to do is you're just trying to cover the one standard deviation move by buying the put that's going to cost you the least. Generally, the ratio, if it's priced well, the time spread's priced well, it's like 5 to 1, 5 spreads to 1 put. Right? Because in my head, I'll think, yeah, if we get anything close to this, I look like I'm going to make 800 bucks. I'll spend, 89 cents twice on protection. Right? That's much better odds, right? Because vol is going to jump if we go down. And that changes the way the risk profile looks. Okay? This is, again, you asked about calendars, like standard calendars and double calendars, directional calendars. I believe, what was it? It was Sui that asked that question. Yes, you can still use regular calendars and double calendars. You can use directional type calendars. Again, setting it up, what's the risk profile? What are you going to get? So the class covers situations for credit spreads versus when to use diagonal spreads and how to use one standard deviation. Yep. We're definitely, a big part of the class is hedging and managing the blown up position. So what we do with that is we have examples, Mike. He's saying, well, the class covers situations for credit spreads. We have examples. Okay, you put this trade on, or you think you want this trade. Now let's run through what happens if things kind of don't go right. What can you do? And then you actually start to see if it's really a well-priced trade or not. So our tendency is, okay, we have an opinion that gives us an idea, then we go in and price it and see if it works. If it doesn't really price out, I tend to pass. So if this is a dumb question, forgive me. Where do you get the standard deviation number for the stock you're working with? Not a dumb question. It is the straddle. Remember when I was talking about the straddle for Alibaba was what, $4 a couple of days ago? Right. So right now it's telling you $3. Right, $3. Right, now it's a couple days into the trade, but you're expecting a $3 move between now and the end of next week. Right, because remember, the at-the-money straddle near term is the market's best guess where things are going to price. Because you've got all of the players are trading that, right? What kind of win rate is reasonable to expect an approximate return on risk? It all depends on how much risk you put on, Mike. Like I said, I like looking for somewhere between, I want 50% return if everything goes well. If I'm not seeing those, if you're not seeing, put it this way, if you're not seeing fat potential return for the spread versus the risk you have to take, then you don't do it. I'm looking, because the only way you make this time spread money is if it on expiration it just dies at the pin, right? There's no way you're going to see that unless you're massively lucky. So I'm usually, what I do is I take half of the expected return if everything goes right. Okay, I've got $1,000 into it for the trade, and I'm looking at around, maybe if things go perfectly, $800 or $900. That's a time spread that has potential, right? But if you got to spend 1,000 only make 100, it's awful. I'm not going to talk about iron condor pricing right now, but yes, we do use Delta, and right now they're my least favorite trade. So you're looking within a $3 time frame on the term that they give you. So if I'm looking August 26th, the straddle's $3. Again, remember, that's the market telling you based on that vol where it's going to be. They're saying that's a 23 vol move. Our strategy letter probably has 8 or 9 positions on. I think I have 4 positions right now. So it's position-wise for us is more percentage of capital. Right now, I'm too busy. I can't handle more than 4 or 5 positions. My best trading this year is of all products. It almost is every year. That's a whole nother topic, though. And now Twitter. It was my crappiest, and now it's one of my best. It was, but that's what it is. We're not really going to discuss flies. We do have a butterfly course. There will be some diagonals, but it's 3.5 hours, so. Does iVol or LiveVol have any advantages over Thinkorswim when you construct trades around vol? I like LiveVol better because I can hold the pricing. When I need to, it remembers I can punch in volatility where I put stuff on. So almost all of our clients, or not all, but many, have a LiveVol account and they have a Thinkorswim account, just depending on how they want to look at stuff. But I mean, Thinkorswim is like a technical chart type program that's built around, different, just different stuff. I've never been really that type of option trader, so I was always a vol trader. And LiveVol was designed by guys at my pit when I was in San Francisco. So it's more what stuff that market makers want to look at. I want to look at, where the volume is, what the vol's doing. I'm kind of like, I like to see price and volatility movement. Clifford, he's saying, can you compare LiveVol to OptionView? We have the same thing. Guys have OptionView and they have a LiveVol account. OptionView is kind of the static and it's for back testers, really. And people that use it like it. So I think OptionView is a solid product. It's one of those things I think people get used to it and they like it. But it's definitely they have a little forecasting tool and stuff like that. Do I offer courses on? We do. We do have some stuff in our. We have stuff in our store. You can go look at that first. We offer stuff in our gold class. Is basically how you use volatility. That's what I would say intermediate. And then we have our platinum class is just applied vol. So almost everything we do, Mike, is actually volatility and then advanced volatility, to answer your question. Yeah, let's go to the store. All right. Boot camp is good for basically learning Greeks if you don't know anything. The VIX futures and option class, how VIX works and vol products work. There's volatility in the Condor class. This was a great course on if you want to get better at taught by basically a commodity option trader. This was great for volatility as well on long-term strategies. The VIX primer was very good, and the option pit vol primer was good. Those are more on the ETFs, the vol ETFs. Basically, you get all this stuff if you're a gold member. And gold, there's 12-part education, and it's mostly volatility. Volatility and how it affects the Greeks and all that stuff. So you will learn how it works. And then the platinum thing, of course, is if you're a gold member. If you go to our page, basically gold is what most people buy because you get Option Pit Live, you get sort of the daily chat, basically learning how to structure stuff. If I could find my mentoring page here. Where the heck is it? Oh, there it is, mentoring services, right? So gold, you get basically our vol course. You get access to all of our past webinars that we post. Live chat room, the strategy letter, which follows along all the trades that we post every day. You also get all of the individual labs. There's 2 per week. And we have a history of all of that stuff. So if you're a gold member, and if I go like, okay, gold lab, volatility. Let's see here. What do we have? Volatility. All right. Let's see here. All right. So what they do is all of this literally have probably 200 webinars on vol, edge in the vol products. What's a high vol stock? What's a low vol stock? What's realized vol? I mean, it's endless. So that's why people like the gold class. Because it gives them a level of access to education, and then you have the live stuff every day. So that's what most people buy. So in the end, summary, decay is right. So what I'm trying to get you to look at is where is the decay really going to make you money when you're looking at weeklies? That's what we want to get you focused on. Little tiny options, generally we'd rather have our clients buy them back when they're shrinking. Are you able to compare your training to that offered by OptionView? I don't know. We have a lot of OptionView clients, Clifford. They tend to stick around. So, we have a lot of people that like our stuff. So, and we keep records of our So one of my clients is saying, "Get real. Nobody compares to what you guys have to offer." So it's pretty good. It's very good, actually. Trevor's question: how would you have changed the strategy if IOE was not at the lowest level? So time spreads really aren't going to work that well. We would actually, again, it depends on the pricing. Because I want to get long, it might be a ratio spread, or we just might not have been interested in it at all. Oh, and my vol product trading did not lose 100% in the last year like OptionView's XIV system. No, it didn't. We've actually done a little better than that this year. Where's our strategy letter? Hold on. Because we just follow when we finally come up with a trade, we follow it. So actually today's going to be a good day for us. But this year we're up 11.5%. So we keep track of everything. You enroll for the Saturday course, just go to our site. Go to events and enroll. It's $147. Also, too, with our gold class, if you want to spread the payments over 4 payments or 5 payments, we'll do that as well. So we're pretty easy that way. And I believe this is the deal that Mark's giving you, is trading debit and credit spreads for maximum profit. But if you send me a note at andrew@optionpicker.com and you want something else, let me know. Not this time. Like I said, I'm just filling in for Mark. It depends what kind of contest or giveaway you want, Michael. So when we do the Saturday class, we'll have a quiz, and the first person to answer me the quiz will definitely get a goodie. Like, they'll get 3 months of Option Pill Live or something. I want people to pay attention. All right, any other questions? Yep. So the thing with the gold package he's asking is all this stuff. Our gold class, basically, you get everything in the store. Whoops. You get everything in the store. You get the whole gold education package. And you have 4 months of basically access to all the live education. The chat room, strategy letter, and the gold labs. So you can see here, so this is my schedule, right? Like the chat room started there around 10:15 to 11:30 every day. We record the pit report for people to basically to update you on what's going on. And we'll have a gold lab on Thursday afternoon and Monday evenings. So that's what you get. So if you enroll in gold, you get access to all the stuff. So it ends up probably, retail, it's cheaper to do gold because then you basically get all the other stuff for free. But like I said, there is hundreds of hours. Yep. So all this stuff should be, again, when you log in for whatever you signed up for, it should be all there. Right? So anything you've paid for ends up in basically my courses. Okay. I'll stop recording now.